Welcome to The Upside. Focus on making you a better investor. We hope to provide you with information and insights that go beyond the headlines, bringing in experts from all over the financial world. From portfolio managers and investment professionals to retirement and tax experts, we want to help you stay on track to becoming a better investor. Welcome to the show. I'm your host, Emily Nuevo. Well, it's a brand new year and decade, and 2020 has already started out in full force. Tensions between the U.S. and the Middle East are rising and changing every day. The U.S. election, although in November, remains a high risk on the markets, and some financial experts say we will avoid a global recession in 2020, while others would disagree. So, what does this all mean for the average Canadian investor? Joining us on the show today to give his outlook on the global markets is portfolio manager David Tulk. David manages a number of funds on our asset allocation team alongside David Wolf and Jeff Stein. As portfolio manager and through his former roles at the Bank of Canada and other major investment organizations, David has earned the respect of his clients with his deep understanding of Canadian and global macroeconomic analysis. David, very happy to have you on the show today. Welcome.
Thank you for having me. It's a pleasure to be here.
So 2020, a brand new decade. I guess before we get into all of that, we have to talk a little bit about sort of what has happened towards the end of 2019 and how that would set up what will transpire in 2020.
Certainly, yeah. So 2019 was a very good year for many different asset classes. A large part of that was due to the efforts of central banks to support financial conditions. And that came in spite of evidence that the global economy cooled pretty significantly over the course of last year, as well as a number of shocks on the international trade front, as well as with ongoing negotiations around the Brexit issue as well. So as the year ended on a relatively strong footing, we start to think a little bit about 2020. And I think next year may be a little bit more challenging of a year. It certainly will not likely be as strong as what we saw last year. And one of the reasons for that is that the market is generally more expensive. So that does limit some of the upside, and it does put a lot more pressure on the global economy to follow through. So it has shown some signs of stabilizing through the turn of the year, but what we would need to see to justify the more expensive market is a continued or renewed acceleration in global growth.
Okay, so, and some experts are saying that 2020 will start out a little bit rocky. I'm interested to know, in your mind, some key themes you see will transpire in 2020.
Yeah, I think the first theme is really just keeping a very close eye on global growth. So that ultimately sets the fundamentals upon which the earnings of companies are based, and that will tend to drive the performance of financial markets over the longer term. So here, again, the evidence is a little bit mixed. There has been some stability we've seen, especially as some of the issues around international trade have faded a little bit from the worry side of the market. But again, what we really want to see over the course of the year is that growth can not just stabilize, but potentially re-accelerate. And that, again, also comes down to the efforts of central banks. So central banks have been known previously to take the punch bowl away from a party before it gets going a little bit too aggressively. And so we want to see, make sure that central banks continue to provide the financial accommodation necessary to not only underpin the global economy, but also to reinforce financial markets. And every indication we've been given thus far is that they are willing to do that. But again, a lot can take place between now and the end of this year and into years to come. So that's one thing I think you also want to be very mindful of.
Okay, a lot there. And we know that, obviously geopolitical issues affect the markets, greatly. We can't go without saying, the tensions between the U.S. and the Middle East are rising, are changing every day. So I guess my question is, should investors be concerned right now?
Yeah, I think investors should be certainly aware, but I would encourage investors not to panic. And this is something where, as you try to navigate not only the tensions in the Mideast, but as we look towards the U.S. election in November, a lot of these events, I think, are ultimately unknowable. So one of the approaches that we will take as portfolio managers is to just have a longer investment horizon. So we can weather some of the shorter periods of volatility as long as our underlying macro story is staying true. So one thing that I would also encourage as part of that longer investment horizon is to be globally diversified. And what I mean by global diversification is both across geographies as well as across different asset classes. And that's exactly the type of products that our team manages. They're balanced funds, they're multi-asset class solutions, so that we can take exposures into, for instance, emerging market equities that would tend to perform well if the global economy accelerates. But we also have positions in gold as well as long duration treasuries and some inflation protection to handle situations in the market that might be more volatile.
Okay, you mentioned emerging markets there and gold. I want to hear your thoughts on emerging markets. What do you think will transpire in that sense this year?
Yeah, well, among emerging markets, that's one of the areas of the global economy that would certainly benefit if you see growth stabilize and continue to maybe accelerate, especially if some of the tensions on international trade maybe fade a little bit further, and if there's some form of at least an agreement in principle between the United States and China, that can allow growth to certainly benefit emerging market economies specifically. I would also say that with emerging markets, they tend to be a little bit cheaper than developed market equity markets. So from that perspective, maybe there's a little bit more of a catch-up that can take place there as well. And I should also mention that in the context of emerging market equities, it's not something that we look at purely in isolation. We often look at it in comparison to another asset class. So the pair trade, I guess you can frame it as, that we look at is to compare emerging market equities to Canadian equities. And in choosing between one versus the other, our sense is that you will have more upside out of emerging market equities relative to Canada. So it's been our positioning decision to give a little bit more capital into those markets at the expense of Canada.
Okay, and gold, David, you mentioned gold. How do you think that will do this year?
Yeah, it's tough to say. Gold is, again, one of those very tricky asset classes to forecast. But from our perspective, especially if you're looking at a world where geopolitics remain a source of concern, gold is traditionally viewed as one of those safe haven assets. What's also true is that central banks, again, if they continue to remain accommodative, and if they have a bias maybe to provide a little bit more stimulus if some of these event risks materialize, gold also tends to do relatively well in that instance as well. So having gold to serve a number of purposes, it does add a little bit of defensive lean to our overall positioning and is a nice hedge to have in place.
Let's talk about the Canadian dollar. Sort of remains steady towards the end of the year. But what does a weaker Canadian dollar mean for the average investor?
Right. So we manage global portfolios for Canadian investors. And one of the important decisions that we make as part of the management of these funds is what to do with the currency and what to do with foreign exposures. So it is our decision generally to make a call on the direction of the currency. Again, I would discourage trying to make very short-term forecasts. The currency is one of the most volatile asset classes out there. But from our perspective, we're trying to look at it over a longer horizon. And as we look at some of the challenges that I think the Canadian economy faces, both in terms of elevated levels of household debt, a challenging infrastructure for the energy industry, some of these challenges mean that we need to see, ultimately through time, a weaker Canadian dollar. So from an investor's perspective, if that's the expectation and if it ends up coming true, you will benefit from having your foreign exposures left on an unhedged basis. So in fact, if those assets, even if they do nothing in local currency terms, but if the Canadian dollar falls, then you as a Canadian investor will see a stronger return. So that's one of the decisions that we've made, is to leave our foreign exposures on an unhedged basis in addition to being underweight Canadian assets.
Okay, you mentioned household debt amongst Canadians, but real estate did fairly well last year. So is there anything that you see would concern people who want to get into the real estate market this year, anything to curb their enthusiasm?
Yeah, we look at the real estate market as an input into how we want to allocate to the Canadian market versus other markets. So it is an important driver of Canada. It certainly has contributed to a lot of the growth that we have seen in the Canadian economy, but what it also has done is it has left Canadian households in a relatively vulnerable state. So that is an unsustainable development. It will, through time, need to be reconciled. And that will, at least from our perspective, lead to the weaker Canadian dollar that I mentioned earlier. But as we think a little bit about the housing market, there are two main drivers that I think that investors need to appreciate. The first is interest rates. And again, the fall that we saw in interest rates last year was able to at least revive part of the Canadian market. So that's allowed some of the recovery to take place. But another factor that I think also needs to be appreciated are conditions in the labor market. And Canada's labor market had been quite strong, but some of the very recent data points has shown some signs of weakness. And I think that would probably be a larger source of concern as we were to look at not just how the housing market performs, but indeed not only the Canadian economy, but Canadian assets as well.
Okay, switching gears a bit, I just wanted to get your thoughts on, do you think the bull market will continue in 2020, continue at a modest pace, or aggressively? What are your thoughts on that?
Yeah, I think it'll certainly be very hard to match the pace that we saw through 2019. But I think that as long as central banks remain accommodative and as long as you see some of the geopolitical risks at least remain fairly muted, then the environment in the global economy as it starts to stabilize and as we maybe see an acceleration in growth should be relatively good for the equity market. It should be relatively good for credit as well. Again, the challenge that we see in trying to invest in this market is recognizing that a lot of asset classes are already fairly expensive. So the hurdle over which they have to overcome to see the type of appreciation that we saw last year, that's pretty significant. So our assessment at this point is that the market can continue to grind higher, but it won't come close to what we saw last year.
We mentioned off the top of the show the U.S. election. That's obviously coming up in November, and it's been I would say, a major point of concern maybe for investors. How should they be viewing, the potential results of the election? And because they're calling for, if Trump wins, then recession or not recession. If some of the other candidates win, maybe it's just a matter of time before we see a global recession. So what are your thoughts on that?
Yeah, I think trying to predict the election, that's a very difficult thing, just like any other geopolitical event. We certainly saw an example of that going into the 2016 presidential election, which surprised virtually everybody as well. So, again, our response to that and those themes are to take a longer term view. So again, we know that politics can certainly influence the economy, it can certainly influence financial markets, but if we maintain a globally diversified portfolio and we pay much more attention to the underlying fundamentals when it comes to economic growth and inflation and interest rates, I think that gives us the tools that we need to allocate assets effectively and to prepare our portfolios for any number of different outcomes, so that if the portfolio is durable to victory from either party, then we've done our job well.
And just curious to know, start of a brand new year, you and the other members of the asset allocation team, how do you prepare, your portfolio for, the ever-changing ebbs and flows of the market and the volatility? What is sort of the plan going into 2020? Yeah,
I think the plan is basically as it was last year, where we're watching the cycle very carefully. It has been a long cycle, and there are some pockets of vulnerability. We've touched on some of the issues that could certainly go wrong this year. But at the end of the day, we want to maintain that longer term view. We want to stay fully invested. We want to stay globally diversified, both across geographies as well as across asset classes. And that just makes the portfolio as durable as possible to any number of different outcomes. And we watch the incoming data and news flow very carefully, and we're always testing our thesis. So our core thesis that underlines our positioning will be subject to all sorts of volatility and all sorts of new information. And we always want to make sure that as long as our underlying thesis remains intact, we will maintain the same investment approach. When the balance of evidence shifts to maybe challenging our core thesis, then we'll make an evolution in the way we approach the market, and that'll come across in some of the positioning changes that we will make as well.
And David, just to wrap up the show, some key takeaways you'd like to share with our viewers and investors in terms of 2020 and the outlook on global markets.
Yeah, I think this is maybe a common theme from what I've talked about thus far, but again, it's diversification, especially when we have these tail risks out there that are very hard to try to handicap and try to predict the specific outcomes. At the end of the day, if you maintain that long horizon and you have that balance of asset classes that do different things in different environments, that I think serves an investor relatively well and will sort of set the keys for success, not only in this year, this decade, or all through time.
David, I want to thank you so much for joining us on the show and sharing your insights of the year ahead and the new decade that it is. So thank you very much for being here.
You're very welcome. Thank you very much.
And thank you so much for watching. As always, we welcome your feedback, so feel free to reach out to us at fidelity.connects@fidelity.ca. Thank you for watching, and we'll see you next time.